Greetings and welcome to Stock Explorers. Today, we're taking a deep dive into Riot Platforms.
Yes, we'll be looking at their recent moves, especially trying to understand the why behind them.
And our main goal here is to unpack the most relevant points for anyone considering investing in Riot, starting with their big announcement about a new credit facility. We'll keep it clear and focused.
Sounds good. We'll use that news as a jumping-off point to explore their overall strategy, financials, and where they might be heading.
Okay, let's get straight to it then. April 2025, Riot announces this $100 million credit facility. And the lender is interesting, Coinbase Credit.
Right, a subsidiary of Coinbase Global. And importantly, this is Riot's first loan facility backed by their own Bitcoin holdings. That's a significant step.
Definitely. Can you tell us a bit more about the structure of this loan? It's not just a standard loan, is it?
No, it's structured as a multiple drawdown term loan. So basically, Riot has a 2-month window after it becomes effective to draw down funds as they need them, rather than taking the full $100 million upfront. Gives them flexibility.
Okay, flexibility. And the interest rate, how does that work?
It's variable. It's set at the higher of either the federal funds rate upper limit or 3.25%, and then they add 4.5% on top of that.
So when they announced it, what did that translate to, roughly?
At that time, it implied an interest rate of 9.00%. There's also a floor, though, at 7.75%, meaning the rate won't dip below that even if the Fed funds rate drops significantly.
Got it. And the collateral is their Bitcoin, as you said. How long do they have to repay?
The initial term is just 364 days, so just under a year. But there is an option for a single 364-day extension.
Subject to Coinbase's approval, I assume.
Exactly. Coinbase has to agree to that extension.
So why do this now? What's the official reason given for needing this $100 million?
Riot stated it's for key strategic initiatives and general corporate purposes. Kind of broad, but CEO Jason Les elaborated a bit.
Oh, yeah. What did he emphasize?
He framed it as strategic, importantly non-dilutive, which is key for shareholders, and having an attractive cost. He also mentioned it diversifies their funding sources.
Non-dilutive is a big point, right? Means they're getting cash without issuing more stock and potentially lowering the share price.
Precisely. And Mr. Liz also stressed that this gives them immediate capital without forcing them to sell their Bitcoin holdings. They get to keep holding their mined Bitcoin.
Which they seem quite committed to doing, so they preserve their Bitcoin stack and get cash.
Exactly. And the timing is interesting too, isn't it? It comes, after the Bitcoin halving in 2024, which made mining more expensive.
Right, squeezing margins.
And it also happens to coincide with this potential big acquisition they're working on with Rhodium assets.
Ah, yes, the Rhodium deal. We should definitely talk more about that. That involves a pretty large cash payment from Riot, doesn't it?
It does. About $129.9 million in cash is part of that proposed deal.
Yeah.
So you can see how this $100 million facility might line up nicely to help cover a big chunk of that.
Makes sense. And they're also looking at using their big Corsicana facility for AI and high-performance computing, right? That could need capital, too.
Good point. Evaluating that AI HPC opportunity might require some upfront investment, even just for planning and initial infrastructure assessments. So this facility provides firepower for that as well, without dipping into existing cash or selling Bitcoin.
So it seems strategically sound on the surface, fund growth, preserve assets, but what are the risks here? Using Bitcoin as collateral sounds volatile.
It absolutely introduces risk. Leverage risk is the main one. Bitcoin's price, as we all know, can swing wildly.
So what happens if the price of Bitcoin tanks?
Well, the value of their collateral could fall below what's required by Coinbase. That could trigger a margin call.
Meaning Riot would have to pony up more Bitcoin or cash.
Or cash, yes. Or occasionally be forced to sell some of their Bitcoin collateral at possibly a really bad price to pay down the loan balance. In a worst-case scenario, Coinbase could liquidate the collateral.
Okay, that's a significant risk factor for investors to watch. Bitcoin's volatility isn't going away. What about relying on Coinbase as the lender? Any risks there?
There's always counterparty risk. Coinbase is huge, obviously a major player. But the whole crypto space faces ongoing regulatory uncertainty.
Right. So if Coinbase ran into serious regulatory trouble or financial issues, that could potentially affect Riot's loan.
It potentially could, yes. It might impact their ability to manage the facility or approve that extension we talked about.
Yeah.
So while useful, this loan isn't risk-free.
Okay, so this credit facility is a key piece of the puzzle. To understand its significance better, let's look at Riot's overall financial health. How did they actually perform in fiscal 2024?
Well, 2024 was actually a year of record revenue for them in some ways. Total revenue hit $376.7 million, up 34% year over year.
And that was mostly from Bitcoin mining.
Primarily, yes. Bitcoin mining revenue was $321 million, a big jump 70%, mainly because the average price of Bitcoin was higher throughout 2024 compared to 2023.
Okay, higher revenue sounds good. But didn't they actually mine less Bitcoin?
Ah, yes, that's the crucial flip side. While revenue went up because of price, their actual Bitcoin production decreased by 27% year over year. They mined 4,828 Bitcoin in 2024.
Less Bitcoin mined. Did their costs go up too, especially after the halving?
Dramatically. This is a really key point. Their average cost to mine one Bitcoin skyrocketed to $32,216 in 2024. Compare that to just $3,831 in 2023.
Wow, that's a massive increase. $32,000 per Bitcoin. What drove that huge jump?
Several things. They got way fewer power credits than the year before, which had previously subsidized their costs significantly. Then you had the halving itself cutting the block reward in half.
Makes mining inherently less profitable per block.
Exactly. And on top of that, the overall Bitcoin network difficulty kept rising, meaning more computing power and energy were needed just to compete and mine each coin.
So higher Bitcoin prices helped the top line, the revenue, but the underlying mining operation got much, much more expensive. How did that affect their bottom line, their overall profit for the year?
Despite those rising costs, they actually reported a net income of $109.4 million for fiscal 2024, which is a big turnaround from the $49.5 million net loss they had in 2023.
A profit is good, but how did they manage that with costs soaring?
Well, their adjusted EBITDA also hit a record $463.2 million, which was up 116%. A lot of that reflects their HODL strategy. The value of the Bitcoin they held increased significantly on paper.
Ah, so paper gains played a big role. Was the profitability consistent through the year?
Not really, no. If you look quarter by quarter, they actually had net losses in Q2 and Q3 of 2024.
Okay, so the full year profit wasn't evenly spread. Was Q1 particularly strong?
Q1 2024 looked very strong on the net income line, but it was heavily influenced by a huge unrealized gain on their Bitcoin holdings. This was due to a new accounting rule change.
The fair value accounting standard.
That's the one. It requires them to mark their Bitcoin holdings to market value each quarter. So when Bitcoin's price surges, it creates a large paper gain that boosts net income, even if operations aren't necessarily booming, and vice versa if the price falls.
Okay, that's really important context for interpreting their net income figures. So looking forward from there, what were the expectations for the first quarter of 2025, say, as of late April?
Well, analysts were expecting revenue to keep growing significantly compared to Q1 2024, probably landing somewhere around $160 million. Again, driven by Bitcoin prices staying relatively high.
But what about profit? Or rather, loss?
Yeah, the expectation was actually for a net loss per share in Q1 2025, somewhere between $0.21 and $0.25 per share. Quite a contrast to that Q1 2024 profit figure, which, as we just said, was skewed by that accounting gain.
So continued pressure on operational profitability expected in early 2025.
That was the consensus view. Although, interestingly, there was a positive earnings ESP signal, which sometimes suggests a company might beat expectations.
And did they? What was their production like in Q1 25?
They did have strong production. They mined 1,530 Bitcoin in Q1 2025. That was actually higher than the 1,364 BTC they mined in Q1 2024. So operationally, production was up year over year for the quarter.
Okay, interesting. That leads us back to those strategic initiatives. Let's talk about that Rhodium asset acquisition you mentioned. What's the deal there?
Right. In March 2025, Riot announced they'd signed a non-binding term sheet. The plan is for their subsidiary, Whinstone US, to acquire certain assets from Rhodium Encore, specifically assets located at the Rockdale facility where Riot already operates.
And the price tag was $185 million total consideration.
That's right. Broken down, it's about $129.9 million in cash.
Which lines up with that credit facility.
Potentially, yes. Then there's a $6.1 million deposit being returned to Riot, and finally, $49 million worth of Riot stock being issued to Rhodium.
And this deal also settles all the lawsuits between them, right? They've had some disputes.
Correct. That's a big part of it, settles all litigation. Asset-wise, Riot gets Rhodium's Bitcoin miners at the site, and, crucially, Rhodium's 125 megawatt power allocation at Rockdale.
So this gives Riot full control over the entire 700 megawatts at Rockdale.
If the deal closes, yes. That's the strategic goal. Consolidate operations, get full control of that large power capacity, potentially achieve some cost savings, and put the legal battles behind them.
But it does come with some shareholder dilution because of the stock part of the deal.
It does. That $49 million in stock will dilute existing shareholders.
Yeah.
Depending on the stock price when issued, estimates were around maybe 7% dilution. That's something for investors to factor in. And the whole deal still needs bankruptcy court approval for Rhodium.
Okay. Now, the other big strategic piece, this AI and high-performance computing, or HPC, angle at the Corsicana facility, this feels like a potentially major shift.
It really does. In January 2025, they formally launched an evaluation. They're looking at using 600 megawatts of the 1,000 megawatts or 1 gigawatt they have secured at their huge Corsicana site, not for mining, but for hosting AI and HPC infrastructure.
And they hired consultants to check if this is actually feasible.
Yes, they brought in Altman Solon, Evercore, and Northland Capital Markets to do a proper study.
What did the study find? Is Corsicana suitable for this?
Apparently, the initial findings were quite favorable. The report highlighted the massive secured power, the location relatively close to the Dallas data center hub, plus the available land infrastructure as major positives. It even suggested it could potentially support demanding AI training workloads.
And this evaluation led them to hit pause on building out more Bitcoin mining capacity there.
That's correct. They explicitly halted the planned Phase 2 development of that 600 millijoule, specifically for Bitcoin mining. They're still building the substation infrastructure to support that power capacity, but the focus for using that capacity has shifted squarely onto evaluating the AI HPC opportunity.
What's the underlying logic? Why pivot away from mining towards AI HPC hosting?
The core idea seems to be maximizing the value of that huge power asset they control in Corsicana. Management believes AI HPC hosting could offer more stable, predictable, long-term cash flows compared to the ups and downs of Bitcoin mining.
Less volatility, perhaps, and diversification.
Exactly. Diversify revenue streams, potentially attract a different type of investor who might be wary of pure Bitcoin exposure. We are seeing other miners explore this too, by the way.
But it's not an easy path, surely. What are the big hurdles or risks in trying to become an AI HPC host?
Oh, definitely significant execution risks. Building data centers suitable for AI is complex and expensive, requires very specific power density, cooling, network setups. It's not the same as a mining shed.
And competition must be fierce.
Hugely competitive. They'd be up against established data center players and other new entrants. Securing those crucial long-term contracts from AI companies is key, and there's no guarantee they'll land them on favorable terms. Underutilized capacity would be a major problem.
So a big opportunity, but also big challenges. Let's quickly touch on their operational performance again for Q1 2025. We know production was up. What else?
Yeah, production of 1,530 BTC was strong, a record for them post-halving, actually. The main driver was just getting more miners plugged in and running. Their deployed hash rate grew massively, hitting 33.7 exahash per second by the end of March. That's up 172% year over year.
Were the miners becoming more efficient too?
Yes, they showed improvement there as well. Fleet efficiency, measured in joules per terahash, got down to 21.0 in March. That's a 22% improvement, meaning they're using less energy per unit of computation.
And the first part of Corsicana, the initial 400 megawatts, was fully up and running in Q1.
That's right. Phase 1 at Corsicana was fully commissioned by January 2025, adding a big chunk of that new hash rate. It's the next 600 milliW there that's now subject to that AI HPC evaluation instead of mining.
Okay, finally, let's talk about the stock itself, Riot. How has it been performing, and what's the general feeling, the sentiment around it? It seems pretty lively.
Lively is a good word. Riot stock is notoriously volatile. It tracks the price of Bitcoin quite strongly, as you'd expect, but often with a lag, which frustrates some investors.
And there's a lot of short interest, isn't there? People betting against the stock.
A very high level, yes. Consistently somewhere between, say, 22% and 26% of the float being sold short. That's quite significant.
What does that high short interest tell you?
Well, it signals strong bearish sentiment from a portion of the market. But it also creates the potential for a short squeeze, a rapid price jump, if good news forces those short sellers to buy back shares quickly.
How are regular retail investors feeling about it?
Sentiment there seems really polarized online. You see a lot of frustration about the stock underperforming Bitcoin at times, but also a lot of speculation and hope focused on that potential short squeeze.
What about the big money, institutional investors?
Institutional ownership is actually quite substantial. And maybe more telling, you've seen activist investors like Starboard Value and D.E. Shaw take significant stakes recently.
Activists getting involved often means they see untapped value or want to push for strategic changes, right?
Exactly. Their presence likely played a role in the board refresh. Riot did back in February 2025, bringing in directors with expertise more relevant perhaps to this AI-HPC pivot.
And what are Wall Street analysts generally saying? Price targets.
Generally, analyst price targets have been suggesting decent upside from where the stock was trading in late April 2025. So at least among analysts covering the stock, there seems to be a belief in future potential, despite the risks.
Of course, Riot's stock price isn't just about the company itself. External factors matter hugely.
Absolutely. Bitcoin's price is still number one driver. But general market mood, any news on crypto regulation, positive or negative political comments, interest rates, all that feeds into how stocks like Riot perform.
So wrapping this all up, Riot Platforms seems to be at a really critical juncture. They're dealing with the tougher economics of post-halving Bitcoin mining.
While simultaneously making these pretty bold strategic bets, consolidating at Rockdale via the Rhodium deal and this major exploration of AI-HPC at Corsicana, it's a lot happening at once.
And that Coinbase credit facility we started with is kind of the financial grease enabling these moves.
It seems to be a key enabler, yes. Providing that non-dilutive cash could be vital for funding the Rhodium Cash portion and maybe kicking off the AI-HPC infrastructure build if they commit to it.
But for you, the potential investor, it means carefully weighing those benefits against the risks we discussed, the leverage from using Bitcoin as collateral, and the significant execution risks tied to these big strategic shifts, especially the AI pivot.
Precisely. It's a complex picture. Is Riot still primarily a Bitcoin mining play? Or is it transforming into something more like a diversified energy and computing infrastructure company? That's the big question investors need to grapple with.
A fascinating and complex situation indeed. Thank you for walking us through all of that.
My pleasure. Always interesting to track these developments.
And thank you for tuning into this deep dive. We hope this breakdown helps you in your own assessment of Riot Platforms and the wider crypto investment landscape. Please remember to subscribe, like, and hit those notifications for more explorations here on Stock Explorers.